Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to the podcast. It is June 26, almost Canada Day, almost U.S. Independence Day. Summer is flying by already, Ernest. It's hot in Toronto. I'm sure it's hot in lots of places around the world. But we got a hot show today. So welcome to the podcast. Before we get started on what we're going to talk about, we want to remind you to like and subscribe to our podcast on Apple, on YouTube, on Spotify. Please feed 5-star reviews, likes, thumbs up, thumbs down. We're big boys. We can take the criticism also. And of course, for any of your wealth management needs, Baskin Wealth Management, love to talk to you about your portfolio. Ernest, we're managing about $2.6 billion for about 1,300 families across Canada, and many, many years in the business. Love to talk to you and see if we're a good fit. So with that, we're going to talk today a bit about why we don't own at the moment alternatives and gold and other types of non-publicly traded assets, I guess. We're also going to talk about an update on AI and what's going on there. That kind of links to our podcast we did last week, which was on Taiwan Semiconductor, recent purchase in our portfolio. And then give an update on Kushtard that reported its earnings just the other day. Still trying to get the engine started on its business in the U.S., but some decent numbers that we saw across the board. So Ernest, you grabbed a book out of my office the other day, The Outsiders.
Yes.
For anybody who hasn't read The Outsiders by William Thorndike, very interesting book. William Thorndike has recently done a podcast talking about how it took him years and years to write this book. Essentially, The Outsiders discusses smart capital allocators at publicly traded companies that have been able to navigate their businesses through many, many years and compound returns at strong rates. And I think it was written, 10, 15 years ago?
Yeah, I think it became big when Buffett recommended it.
Okay.
I'm sure if it was written today, Constellation Software would be in there.
Oh, 100%. Any other companies you think that would be there that... Would a Bruce Flatt at Brookfield be in there, maybe?
Possible.
Yeah.
I think there's enough allocators in Canada that you can do a Canadian version of Outsiders.
Yeah. Well, the only unfortunate is no one reads anymore, and you probably only sell 500 copies. But I'm sure it'd be very interesting to us to read. Did you skim the book? Any things you learned or reread on the Outsiders book?
So I've actually read the book many times. I just couldn't find my own copy. But I actually borrowed the book because there was a specific profile that I wanted to read up on in terms of my research for one of the companies that I'm currently taking a look at.
Yeah.
I'm not going to say what it is.
No, we're not going to talk about it.
But that's why I took the book.
So a similar book is called Lessons from Titans. It was written about more of industrial companies, allocators. I read the chapter on TransDigm about 4 or 5 times. I think it would, that really helped me formulate, why I was so stupid not buying it years ago.
Yeah.
You've read that one as well?
Yep, I've read that one. That's another. Yeah, I think my main takeaway from these kinds of books is that oftentimes as investors, we have a framework and a checklist of things that we like to look for. But so often, these successful business people and companies come from situations that you don't expect at all.
Yeah.
So I think there was a story about the turnaround of Honeywell in that book, where the CEO, Honeywell was a mess. They They like the business was declining, the culture was bad, they had a bad balance sheet. Then they brought in this guy, Dave Coates. He was not from a traditional background, didn't speak the Wall Street analyst language, didn't present himself well, but he did an outstanding job in turning around Honeywell.
Okay.
So
Great
just
operators.
Yes. So one of the, it's just something to, that keeps me humble when I'm doing research.
For sure. And, look at the unbelievable job that Larry Culp did turning GE around. When he became CEO of GE, it's now 3 different companies. I think the market cap was 50 billion. Now the market cap of all 3 companies is north of $500 billion. So there is alpha with great operators. We've partnered our clients' money, our money as well, with some what we think are some great operators. Some of them take time. Turnarounds don't happen necessarily in one day. I'm thinking about, for example, Restaurant Brands with Patrick Doyle at the helm. Chairman, yeah, exactly. But, quite involved and quite incentivized to turn it around, but yet to see the fruits of the management's labor at the moment.
Yeah.
So, Ernest, we get caught, the market volatility has been insane, always has been, always will be. We get periods of calm, of course. June so far has been calm, but you have headlines, you have tariffs, you have worries, you have wars. If I would have said to you at the beginning of the year, Ernest, same thing, the same comment 5 years ago about the pandemic, we would have had Trump threatening gigantic tariffs. You would have had Middle East conflict, potential for world war, U.S. launching an attack on Iran. You name it. I mean, there's been more crazy things that have happened this year, and yet here we are. The market in the U.S. and Canada is up year to date. Markets around the globe are up. So you just never can know when a good time it is to invest. And just because the headlines are scary doesn't mean you shouldn't put your money to work. It may be, in fact, the opposite.
And I think if you go through stock market history, at least as far as I've been working, like every year, something is happening.
Every day
something is happening that makes you worry. And if there's nothing to worry about, then you're probably worrying about valuations. The fact that there is nothing to worry about.
Yeah, exactly.
So I think maybe we're going to talk about this a little later with gold, but I think the one of the things that we try really hard to do is kind of look past the headlines, look past the things that are happening around the world, recognizing that there is uncertainty going on around the world, but also recognizing that these companies are the management is running the business and trying to look past them.
And of course, the uncertainty can create tremendous opportunities. Many stocks, as we know, in April fell 10, 20, 30%. Many of them are rebounded. Maybe some aren't at their all-time highs, but there was an opportunity when people were panicking, when the algorithms were selling on every single headline, that you could have bought stocks. I was speaking to someone who said, well, our model showed us that we should have been short on April 9th. That was the day when the market bottomed, right? And so they screwed up for their clients going short that day. I mean, it's just not something we think about or are interested in or trying to, even formulate an idea of how to invest in this kind of market. It's, stick to our process of long-term investing. So on that theme of long-term investing, Ernest, we don't own gold.
Yep.
And gold is on fire this year. Pretty much the last few years. I think the price of gold has touched $3,400, $3,500 US an ounce. I remember when I started my career at Baskin, it was $500-$600. And there was some guy who went on TV and said, if it doesn't reach 2,000, I'm going to shave my head. And it didn't reach 2,000, and he had to shave his head.
Was that you?
No. Oh, that's not nice. I shave my head because this is the look I like. So the bottom line is, we look to own companies that have recurring revenues, have the ability to reinvest cash flows at high rates of return. We try to avoid, for the most part, although we do own some oil and natural gas stocks, we try to avoid commodity-only investments. No question, there's always going to be a great allocator or a great operator in any type of business. I'm sure Agnico Eagle or Barrick Gold or maybe some of the royalty plays have been strong performers. Hard to know right now if it's due to management's ability or just the fact that gold's at record highs. But no question, we've missed that part of the run on gold stocks year to date, and that's obviously led to some strength in the TSX, which I think has 10% or so allocation to gold equities. So so Ernest, a client calls you up and says, you're not doing as well as the TSX this year because you don't own any gold. Why don't we buy some gold? Why don't we buy some gold stocks? What would you say to that client, that caller?
So the common argument to own gold is that it is a safe haven asset where in periods of economic uncertainty, whether it be inflation or whether it be, widespread unemployment and
inflation, war,
all these kinds of things, like historically, and this is true going back thousands of years, you could use gold, that it will preserve its value. You can use it to barter for food or horses or whatever, and that it generally outperforms during periods of economic volatility, especially because the fact that it's a tangible metal, it's protecting its value versus times when governments are printing money and inflation is expected to pick up.
So this is a perfect environment for gold, of course. So much worries with the tariffs, how that's going to play out with the economy, whether it's going to cause inflation or not inflation, worries about conflicts all across the globe, Russia, Ukraine, Iran, Israel, China and Taiwan, North Korea. There's so many worries. But more importantly, we've had a period of very high inflation, right? And so the devaluation of the US dollar, the money printing in the US, the out of control debts. You can create a great scenario where you should just own gold, but that doesn't mean it's going to work from here.
So the problem that I have with gold is, and this is true for a whole host of commodities, including Bitcoin, is that these are fundamentally not cash generating assets. It's the return that you're going to get from gold is 100% what somebody else is willing to pay for gold in the future. And I think I think people say, well, maybe that's true for stocks as well.
Probably true for a lot of, your house, a lot of assets, of course.
But I think the difference is that let's take Visa, for instance, like Visa Corporation, the stock that we own. It's generating cash flows. They're using the cash flows to buy back stock, make acquisitions, and pay dividends. And so right now, I think Visa's free cash flow yield is somewhere around 3 or 4%. After 5 years, right, you're going to have earned roughly 20% of Visa's, your investment in Visa in terms of cash flows that it generated. So that provides a buffer for the stock price and your investment in the company because it's generating
cash
money,
today.
It's generating cash for you today. That's not true for gold at all. If you're comparing Visa stock to gold, the amount that gold just has to catch up to the amount of cash that Visa is generating every year just to maintain a break-even rate of return.
Sure, that's totally understandable.
Yeah. And so it just seems that in the long run, owning something that is generating cash flow is going to do better than something that doesn't generate cash flow.
Yeah. So what happens when maybe things calm down, and everybody's bought all these gold? They bought all these gold bars at Costco. Who's going to want them when stocks are running and everybody feels good about the economy? What happens to the price of gold? How is it defensible? How do you say to a client, "Oh, well, sorry, the economy is doing better than I thought, and things are calmer than I thought. Now we got to sell this thing, and I don't know how to value it, so we're just going to sell it into the market because it is what it is."
Well, I think that's the problem
Yeah.
with owning something like gold. Whereas for Visa, and Buffett has talked about this as well, where for a company like Visa that is asset light, is basically taking a cut out of the volume, payment volumes that go through the business.
For sure.
And doesn't really have a lot of reinvestment needs into the business. Like they don't have to invest in plants and railroads and factories. Like I think it's a pretty good protection for inflation as well, because Visa's earnings are going to rise together with inflation. Your cash flows and return as a shareholder are going up together with inflation. Whereas for gold, if those things don't happen, like it's very likely you're not going to get any return at all. And especially at a time when kind of the consensus view about the U.S. fiscal situation and about interest rates and inflation and the economy and whatnot, those are fairly consensus opinions among like macroeconomic observers today. So to me, like I think that it's just, I understand the people who are worried about those kinds of scenarios to say that they want to own some gold in it. But to me, it just makes a lot more sense to own high quality businesses where you are protected in the situation of inflation, but also having a margin of safety to protect you with the cash flows that they're making.
Preach, my brother. So the other asset, of course, that we don't own for clients is alternatives. Right. And so we've talked about this on the podcast before. Alternative is anything alternatives to regular stocks and bonds, right?
Yes.
So it could be mortgage funds, it could be private credit, private debt, it could be private equity, God knows. And they keep coming out with more types of alternative assets.
Liquid alts now.
Yeah, liquid alts, whatever that means. So no question, over the last few years, the market has been extremely volatile. And when interest rates were very, very low, they're more meaningful today, but up until, let's say, 2022, you were getting 1 or 2% on your bonds, nothing on your cash. And maybe advisors are like, I don't want to put 100% of my clients' money or my own money into stocks. It's too volatile, and I can't put them into bonds because I'm not earning my fee. What's my alternative? My alternative, obviously, is to invest in these alternatives.
Right.
And so there's been a proliferation of alternatives, dramatically so. You've seen retail investors, institutional investors, you name it, start piling into these, and advisors selling them. Obviously, investors trust their advisors' recommendations, and so as they should, and hopefully they're doing what's best for the client's interest, not best for their own interest, and so this is what's happened. So why don't we own alternatives? I mean, there's many, many good reasons. I've said it before on the podcast. One of the things that I really love about the way we're set up for clients is they can call us up tomorrow and say, you know what, my daughter's buying a house and I want to help her with $150,000 or $200,000 of cash.
Right.
And I can sell some stocks, I can sell some bonds, I have the liquidity to do that. Whereas if that kind of money was stuck into a alternative asset, I have no access to that for 30 days, 60 days, 90 days, or God knows how long.
Right.
And I certainly don't know what price I'm going to get when I sell it. Right. And so, and of course, there's many companies where they're gating their assets now, right? Whether they're into real estate, which is tough right now, so you can't even get out of these assets, or you've made an investment in some raw land that's hoping to pay you out in 10 years. I'm not going to say it's criminal, but I would say that for those that don't have multi-million dollars, my opinion, for whatever it's worth, should not be in alternatives. Those that have significant net worths, 10 million plus, yeah, go ahead and take a look. If you feel you have enough in equities, you feel you have enough in fixed income, you feel you have enough in liquid, and you do have that generational wealth and you want to diversify your assets, that's probably the asset class for you. But we're thinking here that alternative assets have no place whatsoever in regular millionaire next door portfolios.
I think the argument often for alternatives broadly speaking, is that it provides you with access to deals that and assets that you may not otherwise have access to in the public markets.
Fair.
So, for example, there was, from time to time, you might see like there's a fund being raised to acquire, I'm just making this up, like student housing in near Waterloo, something like that, right? And so if you had a very strong view that that was something that you wanted to invest in, and you didn't mind your money being locked up for 5 or 10 years, then that's probably the only way you're going to be able to play this theme, is to find a private or alternative fund that manages student housing in Waterloo.
I get how nervous the volatility of the market makes a lot of investors, and I can see the appeal of these alternatives. And so I would recommend investors, instead of adding those type of products to their portfolio, why don't you just invest in the companies that make those alternatives? Right. You can buy shares of Brookfield, which our clients own. You could buy Blackstone. You can buy Carlyle, KKR, Apollo. These are gigantic private equity companies that make a ton of money, charging tremendous fees and performance fees, and they're liquid, right? So there's lots of different ways to play it. I don't understand why anybody needs alternatives in their portfolio, but certainly, the world is a big place, and you're free to do whatever you like, and we're free to invest however we like for our clients. And at the moment, we haven't found anything outside the traditional stock, bonds, long only type investment that meets our temperament, our patience, our comfort level for investing. And the final kicker is, you get to invest in the world's greatest businesses. The best businesses in the world are publicly traded companies. And if they're not, they will be publicly traded at some point, because that's where most of the wealth is generated over the long term.
Yeah, I think especially with regards to alternatives in real estate or private credit, it does seem as though the liquidity that the funds often market themselves as having is a bit of an illusion, because what happens is that, they might say you can redeem on 30 days notice, but the time that you are most likely to want to redeem is going to be the time when everybody is probably trying to redeem.
Yeah.
And so what happens is that these are private assets that don't have a public market for them. And the fund just doesn't have enough liquidity to be able to manage all the redemptions. And so they freeze redemptions. And we've seen this kind of publicly in some notable situations in Canada.
Across the globe, it's just common. Yeah.
They are forced to freeze redemptions. And those who originally were not thinking about redeeming, now they're incentivized to redeem, because most likely what will happen is that the fund will have to sell their most liquid, highest quality stuff to meet the redemptions. And so those who are left with the garbage, the dregs of the portfolio. So once this process starts, I think it's very, very hard to reverse the trend. And I think that's one of the things that people don't often realize when they're investing in these firms, in these funds.
So one of our partners here worked at one of the large banks. We'll keep everything anonymous right now.
Yeah.
And when he had a very senior job at one of the large banks and on the investment, on the wealth side, and they had tried for years all these different alternatives. Nothing ever produced the types of return that long only owning good quality stocks performed. And they never satisfied clients, and maybe it turned out to be good for the advisor, maybe able to defend their fees more, charge higher fees, take performance fees. But over the long term, they never found a satisfying asset class to be in, and no strategy, no style works forever also. So we're done beating a dead horse. If you ever want to talk to us about our strategy and our investment philosophy and learn why we don't buy all these other assets, obviously, please reach out to us and speak to your portfolio manager. Any new developments in AI, Ernest? As we talked about last week, our latest purchase is Taiwan Semiconductor. making these incredibly small nanometer chips. I see they've announced more news, possibly working with a lot of different companies. It just seems to be, the demand seems to be off the charts. We're still at the beginning of this AI boom. Some are calling it speculative. Some are saying it's the start of the biggest bubble the world will ever see. Some are saying no, it's going to be incredible and it's going to go on and on for years. You never know what's going to happen, but things are moving very quickly and very fast with AI. I have young kids who are 18 and 21. They'll be looking for careers shortly. What direction should they head in? What is software coding going to be a thing? Can they become paralegal? Is that going to be a thing? An admin person, is that going to be a thing? Answering the phone? You don't know what the jobs are going to look like. And obviously the next step for AI is what's called agentic AI, where you have all these agents essentially running your life and running your business. And it would be very profitable and productive for companies. But our experience here right now, Ernest, is sometimes it's hit or miss, just like humans.
Yep.
Yeah, people are hit and miss too. But we've used lots of different AI software for many different multiple reasons, and sometimes we get some really decent work out of it, and sometimes we're getting shooting blanks or making things up. So, but it's moving. Obviously, we can all see it moving in a better direction going forward. So, any updates on your thoughts on AI or what's going on?
So I want to take this at a bit of a different angle today, where instead of talking about is AI going to change the world, or is it a bubble, or is NVIDIA stock going to crash? Like, instead of talking about it from this perspective, I think you sent me a message a couple weeks ago at like 10 p.m. Where you said, I think we got to think through the implications of AI on all of our companies in the portfolio. And I think it was a really interesting thing to work through, because I think it really forces you to dig into exactly what value these companies are creating on behalf of their customers. And so maybe I'm going to the side a little bit, but a week ago I was having lunch with somebody that I know who works in the energy industry.
Okay.
And he was talking about how today in the energy industry, they are already using robots and AI to automate a lot of the most dangerous work that comes with regards to maintaining the oil rigs, doing inspections, those kinds of things. And I think the question then becomes, okay, so it's all nice and fine, but how much of that value is going to end up being captured by the oil company versus being commoditized and the benefits just resulting in lower cost structure for the energy industry overall. And so I think it really comes down to the quality of the business that you have and the problem that you're solving for the customer.
If everybody adopts AI to improve their customer service, maybe their productivity will improve, maybe their profits will improve, but those will be, if you don't have an advantage, those will just be taken away over time.
Yeah. So as an example, let's say all the airlines in the world start to adopt AI booking systems and check-in procedures.
Okay.
I think it's not hard of a prediction to make that the vast majority of these cost savings are going to end up resulting in lower ticket prices when people are searching for flights on like Booking.com or Costco Travel. So in this case, there are cost savings from AI, but the benefits are going to go to the consumer. Whereas I think for something like Waste Connections, it's a company that we own, they are a waste provider. They usually are operating in exclusive contract markets or in secondary markets where they are vertically integrated all the way from collection down to the landfill.
And they're number one or two in that market, right? They're the market leader in that area.
Yeah, most of the contracts that Waste Connections have are not even competitive. They just have a relationship with the city where the city might say to them, okay, like just go and collect the trash and ensure that we're getting elected as a city council, right? So in this kind of scenario, I think Waste Connections is going to benefit massively from automation and AI because whatever cost savings they have, it's just going to flow down to their bottom line. It's very
It may not be arbitraged away by the competition.
right. It's very difficult for somebody else to come in and make a competing bid, even if they are providing coming in at a lower price, because for exclusive markets, Waste Connections already has the relationship with the city. They already understand how all the routes work. The city trusts that Waste Connections is doing a good job on behalf of its citizens, and they own the landfill at the end. So those are the kind of situations where I think there is a lot of upside to the extent that AI manages to improve efficiency.
Yeah. So if you're listening carefully to Ernest, we want to think through companies that will benefit, whether they're companies that have some kind of special relationship with their customers, their end users, companies that are in a monopoly or duopoly or oligopoly type structure, where competition can't eat away at their moat or their competitive advantages. Companies that are just so cash generative that they can afford to spend money and innovate on these things. This is where we want to be going forward in the age of AI, and we'll adapt and change as need be.
Yep.
So part of the reason we purchased Taiwan Semiconductor, and you got to listen to last week's podcast because we lay it out perfectly why we think they're going to be the winner in the next in the new economy of AI. And from what Ernest said, it ticks all the points, ticks all the boxes in terms of its competitive advantage, its size, its scale. These are things that are very, very important to us. And instead of investing in a micro cap or a small cap company that might come up with a great AI or new technology idea, but maybe no one adopts it, maybe it doesn't work. Yeah. So we had Kushtard's earnings yesterday. This has been not a great performer in our portfolio. I think we've held it for a year and a half, 2 years now, roughly. So the thesis on Kushtard has not really changed. Great operators, excellent at making acquisitions and improving the operations, keeping costs under control, benefiting from these economies of scale. Everything was rocking and rolling, even did okay during the pandemic when really convenience stores were the only things open. But what's happened lately, of course, Ernest, especially in the U.S., is the U.S. consumer, especially the consumer that Kushtard appeals to, its Circle K brand, has not been strong, and it's been affected by the higher prices for convenience goods, whether it's cigarettes or beer or candy or you name it, right? The prices of all those things have gone up. And so either they're shopping less at those places or they're trading down.
Right.
Yeah. So there's a whole number of reasons. I think Kushtard has two parts of its business, right? Selling the candy and the cigarettes and then selling the gas.
Yep.
The gas business has been fine. That will fluctuate based on seasonality, the weather, but with low unemployment in Canada and the U.S., there should be a lot of people driving, especially in Toronto. What a terrible city to drive in. So, Ernest, you've listened to the conference call. You did some research on Kushtard last night and today. So let's hear it.
I think with the benefit of hindsight, I think the thing that we probably underestimated when we bought the stock was the degree to which the results were benefiting from the current environment in COVID and then from inflation, because not in the sense that like everyone was going to convenience stores, but the fact that because we were in an inflationary period and because everybody was working from home and kind of walking around and able to buy beer and cigarettes and all those things, like those were benefiting results more in the short-term manner.
For sure. So Kushtard, a few years ago, you could buy a chocolate bar for $1.50.
Yeah.
Now, a chocolate bar is $3 or $3.50, right? Kushtard makes a nice margin, and it'd rather make a 30% margin on $3 than $1.50.
Yes.
But maybe the prices went up too high.
Yeah. And we, I think the reality is that convenience stores, kind of due to their nature, it's not a strong growth industry. Like these are not businesses that you expect to grow like 5-10% every year, because so much of it comes down to how many people are living in the area and like just kind of foot traffic along the store.
And some of the things are not in your control, like gas margins, for example. Anything can happen to the price of oil. Sometimes you can do some hedging, or a pandemic where it shuts down the world, no one's driving, or bad weather in a specific area. It's interesting to note, sorry to cut you off, but Kushtard has a lot of stores in the Sunbelt regions, right? And for some reason, because there's fewer Canadian travelers, and it's not seeing as much traffic. A little bit. That's an impact. So parts of its business are doing fine. The U.S., the Canada and European business seem to be very strong, or at least the results have improved, but the U.S. has not.
Yeah, I think when you listen to Couche-Tard's earnings call, they'll talk a lot about, the loyalty program and the fresh foods and all those kinds of things. And I think those are nice things that they should be working on when they're running the business, but they're not really meaningful drivers of the business in the sense that it's going to double the size of the business.
No one's going to Couche-Tard exclusively to buy a hot dog or its microwaved hamburger or its cheap cookies. Once you're there, you're saying, oh, hungry, the cookie's only $1, maybe I'll buy it, right? They'll make some decent margins on it, but unlike some other competitors, specialized competitors in the U.S., like a Casey's or a Buc-ee's, where their stores have become a destination because the goods are so unique or the food is so great, Couche-Tard is not going after that market, and so there's not as much emphasis on the volume at the stores. I think they're trying to change that, though.
No, and that's exactly what's happening, is that I think they realized that they didn't have the capabilities in food that some of these other competitors had. And so that's why they went and bought a company called GetGo, which does have a very successful standalone food attached to their convenience stores and their gas stations, and to see what they can learn from that. And I think that's another thing, that a side benefit of 7-Eleven is because if you go to Japan, you can buy like sushi and you can buy like prepared foods and all these kinds of things from their convenience stores. And that's a thing in Japan. Like people do go to convenience stores to buy food. It's a thing in the United States. People do go to convenience stores or gas stations to buy food. So that's kind of the thing. That's what they have to. That's what the management is working on. I think it'll be like, we'll see how that plays out. But the bulk of the value of the company and why we liked Couche-Tard to begin with was not really about their opportunity in food. It was mostly about their capital deployment, their acquisition strategy, and how they could make money by making acquisitions and improving the stores. Because of 7-Eleven, they have kind of slowed down the pace of acquisitions a little bit. And I think that has also been a drag on the stock performance as well.
For sure. There's uncertainty whether that's going to happen. There's uncertainty as to if it does happen, how they would pay for it. And of course, big mergers and big takeovers don't always work. And if 7-Eleven was such a great asset to begin with, why hasn't 7-Eleven's stock in Japan worked, right? And why are they even considering spinning off 7-Eleven on their own, right? So there's been deep-rooted issues in the 7-Eleven model right now, and there's going to be a lot of heavy lifting for Couche-Tard if they do win the day acquiring 7-Eleven to fix and improve operations there.
Well, we've talked a lot about the 7-Eleven deal and why we like it already, but I think maybe the understated aspect of the 7-Eleven overhang is that they've been preserving their cash and their balance sheet to be able to make this acquisition, and have not been buying back stock to the same pace that they perhaps have in the past.
On the positive side, the leverage has come down significantly, and so has the stock, right? So let's say the 7-Eleven deal does not happen. Well, Kushtard has already improved its balance sheet dramatically, and now it can buy back share. I mean, if you're a long-term investor, do you want your company to buy back shares at a high price or at a lower valuation? You want the lower valuation. So it's not the worst thing in the world for long-term investors to have a stock kind of flatline, as long as you believe that the future looks better than the past. And so what are the reasons, Ernest, to believe that Couche-Tard's future is going to look better than the last few years?
Well, I think you have to take a long view on this kind of thing, because if your thesis, and this is really, it really comes down to how we invest, right? Like, we're not buying a stock usually because we think it's undervalued and then it might pop 30% and then sell the stock.
Yeah, but we never do that.
Yeah. We only buy stocks because we believe in the ability of the management to create value over a 5, 10, 15, 20-year period of time. And so when you have a company like Kushtard, they've had a terrific track record of creating value through acquisitions for 20 plus years. And then they go through a bit of a slower stretch. I think we're more inclined to believe the management that they're going to get through this and things are going to be all right, rather than moving on to something else just because it didn't work in the last year.
And this is not the first time that Couche-Tard's stock kind of flatlined or went negative for a while. They tried to acquire Carrefour in France, big not convenience store, supermarket. The market was very worried about that. Is that a total change of how Couche-Tard's going to be operating? What do they know about supermarkets? Yada yada. I think the stock fell and sat there for quite a long time until that deal didn't happen, and Couche-Tard ramped up its buybacks and started focusing again on the convenience stores. So the future is unknown, of course, but I think there's reasons to be really confident about Couche-Tard's execution. And I think there's a number of free call options on potential upside, a turnaround in some of the same store sales growth, and turnaround in terms of the improvements of the capital costs of running the stores, potential for turning back on the buyback.
Yep.
Potential for offering better services to its customers with loyalty, with better food as they're working on. And so it's going to take a little bit of time. Our expectation, Ernest, is that we'll start to see the improvements. They just finished their 2025 fiscal year. So we think they're going to start to see meaningful improvements in 2026 and beyond. And so even though we look kind of dumb on when we bought the stock and where it is today, we're hopeful we'll look very, very smart in the future. Anything else to add? Any other notes on that?
No, I mean, I think we feel, at least for me, I feel confident that the management knows what it's doing, especially the chair.
Yeah.
Alain Bouchard.
Who has not sold any shares recently, yeah.
I trust that he knows what he's doing and that they're going to get through this.
Very good. So in the next few episodes, we'll almost be at 100. We're going to hopefully have a special 100th episode of our podcast. But we certainly want to answer more of your questions and talk a bunch about not macro, but long-term investing, compounding, and great companies across the globe. And we hope to share more ideas with you in the future, in the coming weeks. Ernest, summer vacations are coming up, so this podcast may not be coming out once a week for a little bit, but we'll certainly be back on track in September. So look out for 1 or 2 podcasts this summer, and then full ramp up after that. And we look to, provide a lot more thoughtful and great information for all our listeners going forward. So with that, we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.